Okay, it is 11 o'clock and we want to be respectful of your time, so we'll go ahead and get started. Just a couple of housekeeping items for those of you who are not familiar with Zoom. All attendees are in listen-only mode, so you are muted. We will be doing a question and answer at the end of today's webinar. So if you have questions, there should be a Q&A panel on your Zoom, and you can submit any questions for us to respond to at the end of today's webinar. I'm going to go ahead and introduce today's presenters. My name is Nicole Renaud. Ian Tennant and Daphne Jordan are also going to be hosting today's webinar. And we are all employees at Pioneer Wealth Management, and look forward to addressing your questions and concerns. Today, we're going to focus on how to maintain your financial health amid the COVID-19 crisis. And we think of maintaining financial health as maintaining a healthy mindset, maintaining your self-care, maintaining health for your pocketbook, and how you use your resources to care for your family. I am going to turn things over to Daphne, who is going to talk to us more about self-care and keeping a positive mindset.
Thank you, Nicole. So I'm Daphne Jordan. I'm so thrilled that all of you can join us today as we look at positive and actionable ways to navigate during this time. So when it comes to financial wellness, it really does start with the mindset. Having strong self-care, having a grounded mindset is vital and can help you be successful. Now, years ago, when I was a teacher, I instinctively knew that if a child came to my class and they were hungry or without a constant place to live, they really wouldn't care about conjugating a verb or finding the common denominator in fractions, for example. So similarly, as adults, if our basic needs aren't met, it's challenging to care about other needs or self-fulfillment. So you need to realize that this is normal, and it's important to do what you can to make sure your basic needs are met, or reach out for help to make sure that you're getting what you need. Now, this is an interesting graphic that I found on a real estate website, and it kind of gives you different zones that you can be in during a crisis like this. For example, if you're in the fear zone, you're going to do things like panic buying, or you're hoarding paper goods and things like that. If you're in the learning zone, then you're going to recognize that everyone's, doing the best that they can while facing this extremely difficult and challenging situation. If you move into, the last zone that is listed there, that's when you can kind of be in a different mindset and be grateful and be appreciative. For example, in the beginning, I was kind of irritated that I couldn't find my favorite brands when I was at the grocery store, but I decided to switch gears and be grateful and appreciative when I could find milk and eggs. So some top tips to consider would be to focus on what's inside of your control. If it's not in your control, just toss that away. It's important to establish a routine, especially if there are children involved. So get out of those PJs and get dressed every day. Instead of watching the news all day, perhaps consider just checking in on the news once a day or so. Exercise regularly, eat healthy. For those who are spiritual, spend time on doing things like praying, etc. Consider spotlighting 2 to 3 main tasks that you can knock out daily so you feel like you're moving along bit by bit. And find a project or a task that gives you joy, things that you have not had time to do before, spending quality time with your family. Maybe take a long walk and talk to a friend that you have not spoken to in years. We're going to have a resource site for you to look at later, but there's 2 items here I want to make you aware of. One is a TED Talk by psychologist Susan David. It's how to be your best self in times of crisis. My favorite parts is when she talks about emotional agility. That's the ability to be our full self in a very compassionate way, not just for ourselves, but also for others. And then there's also this interesting site that's called the Family Dinner Project. And when you go there, you can find some interesting recipes that you can try on a daily basis with your family. There are conversation starters and also game ideas.
Thanks, Daphne. I'm going to transfer it over to Ian, who's going to talk to us more about financial health for your pocketbook.
Awesome. Thanks, Nicole. Hey, everybody. My name is Ian Tennant with Pioneer Wealth Management Group as well. Thank you for joining us here today to do the best that we can amidst a pretty challenging time for a lot of people. Obviously, this feels like a moment in history that's, very unique to us, and in some ways it is, but in many ways, on the financial side of things, at least, there's some sort of cyclical aspect to this, especially from a broader economic perspective. And what we can do is focus on what we're able to control during these moments, because there's a lot of factors outside of our control. Even at the government level, we can see that there's a lot of scrambling to try to make do and sort of catch up for maybe some lost preparation. But hopefully what we get out of today is just being able to fixate and focus on some of the simple changes and actionable things you can do within your own personal financial situation to have a little bit more clarity and peace of mind in your decision making, and hopefully give yourself a break too. So I tried to kind of just push this down to a really simple method, and I'll say before we get into this that some of the advice here today is intentionally designed to be sort of broad, just because we want to make sure this reaches as many people as possible and is as helpful as possible. As always, if you already know us, if you're a client, you can always reach out to your advisor to get in touch about your specific situation. We'll make sure we try to get some Q&A, as Nicole and Daphne had mentioned, by the end of the presentation. But we'll try to focus on some broad, kind of high-level things today, and just know that we will make sure that there's some good resources available to you so that you can spend some time individually looking at these things. And then, of course, if you've got a relationship with us, we'll make sure that you have what you need to know how to get back in touch and how to schedule a meeting. And if you are a new client, prospective client rather, how to go ahead and set something up so that we can start talking. So the simple method for the pocketbook part of this is, I think, when there's a lot of things going at 1,000 miles an hour, it's just needing to sort of slow things down and focus in on the simple, which is identifying your current financial position. And then that'll be defined, as we'll talk here in a second, by a couple different tools that we can do to do that. Prioritizing your short-term cash flow plan. Obviously, with the rush to different loan programs and forbearances and all these different tax pieces of emergency tax legislation that are being passed, cash flow seems to be the biggest thing right now. It's not that something dramatically has changed in the world. It's more so that we've had to slow down a machine that was moving very quickly, and oftentimes the first thing that gets hit is cash flow. So for individuals as well as businesses, I think that's the best place to focus is short term, knowing that this is not going to last forever. Manage your actionable behavior and monthly overhead. So again, you're kind of a moving point in time, and financial planning at its basics level is just a series of cash flows today and into the future. Spending money now, saving money now, spending money in the future, earning money now. And so zoning in on just the next couple months is going to be important so that this doesn't become overwhelming in any way, and also being able to acknowledge what that longer term impact is going to be from today's decisions. And then also acknowledging a lot of things are probably still going to ready to change. There's guidance being pushed out almost every day from different agencies about these loan programs and about tax impacts. There's plenty of room for additional legislation. Every day we're checking in with the headlines and seeing what Treasury is doing, what SBA is doing, what the Federal Reserve is doing to help people amidst this crisis. Adjust as necessary, practice some balance and compassion. So, again, this is not, there's not a magic wand necessarily for anybody, but part of it is just trying to give yourself as much peace of mind when you're making financial decisions and not letting the emotions drive those decisions. So there will be some, like any good financial plan, as you've probably learned if you've worked with us, or hopefully will if you do, they need to be available to change, because no financial plan stays static for anybody's lifetime. And then, because a lot of folks are experiencing income disruption, whether that's a reduction of income or maybe you've been laid off or furloughed, we sort of designed this to focus on that part of it, which is when you're experiencing that income disruption, staying on top of your cash flow is the most important thing to do so that you can manage the amount of drawdown on any savings until the income returns. And the best thing you can do to focus on it when you've lost your income is to focus on the expense side of things, because that's where you have a little bit more control than when you lose a job. So getting into that, a couple good tools for making initial assessment and kind of stopping everything and saying, all right, where am I at, is a balance sheet. This is something we use all the time, and it seems like a tried and true. It's a tool that companies, governments, and individuals use to just know where everything is at one moment. So it's a snapshot of your current financial position. It helps you organize where everything is, will help you in decision-making when determining, specifically in this kind of scenario, where money needs to come from to meet expenses if the income side of things slows down even for a short period of time. Daphne will talk about this a bit later, but with all clients, if you've worked with us, we talk about an emergency fund and the importance of having one. And these time periods are sort of where it shows its value infinitely. And then aside from the balance sheet, the cash flow statement is reflects the expected inflows and outflows of your household over a period of time. That could be weekly, monthly, annually. Right now, annual probably seems a little crazy because that's, there's a good period of time ahead of us. But when things are normal, generally we look at it in an annual basis. In these moments, I'd say it's more important to focus on a narrower period of time, which is weekly, monthly, because that's a lot of things are changing, and we want to make sure that those decisions reflect the time that we're working with. And then the cash flow statement, the importance of that is it's sort of the rate of return of change on your balance sheet. So I give you a quick example below that just says your net cash flow is if you have inflows that are greater than your outflows, then you should be having savings, something left over, which usually means that you're increasing assets or adding to cash, adding to retirement plans, adding to investments, stuff's going up in value, or decreasing your liabilities. You're paying off debts that you have. If, for a lot of folks right now, the inflows have now either become less than the outflows or are zero, then you are spending net, which means that on a balance sheet, what you should see happen is either the assets are decreasing or liabilities are increasing because people are spending down their savings or they're increasing their debt to cover expenses. But it's usually either of those two things or a combination of both that people experience. So the reason why these two tools are super helpful is they're very objective in looking at how your financial position is going to change. And it will give us a good sense of, again, objectively removing the emotion out of things. How can we make the best decisions with what we have? Just a couple quick ideas for tools. We recommend these to folks that we work with, as well as just anybody that wants to organize these things quickly. Obviously, time is of the essence in these time periods. Pen and paper works great. I didn't put that on here, but if you're a pen and paper person, by all means. Otherwise, the next step up is an Excel spreadsheet. I'll give you some examples of what that looks like here in a moment. There's some apps that we've used over time, and there's always a bunch of new ones coming out. Practically every year there's a new financial tech company that's releasing some sort of product. A lot of banks integrate spending analysis tools. So there's a lot of different things not listed on here, but some that are tried and true for us are envelopes, which is that little smiling envelope for budgeting. There's Quicken, kind of an old school thing. Mint is sort of like the newer version of Quicken. The nice thing about Mint is it's a free service. They, just give you ads, but you can ignore it, and it's a good way to organize things quickly and aggregate your accounts in a quick fashion. YNAB is you need a budget that's a little bit more detailed than Mint and a very low cost paid product, less than $100 a year, I believe. Personal Capital, another one of those freemiums that'll help gather your information together and help you create a balance sheet and income statement. And then eMoney is a plug that's the white label software we use for our clients, where we're able to also do account aggregation, as well as kind of complex, robust, comprehensive financial planning and income statement planning. So creating a balance sheet is a snapshot of financial position. Real simple, you're listing assets and liabilities in two columns. Assets are things you own. Liabilities are things you owe. The net worth on a balance sheet is just the difference between the two. So if you took everything that you own today and sold it to pay off everything you owe, what are you left over with? That is what we in finance call your net worth. Quick rundown of some asset types, because this is, again, going to be something you do if you haven't already, is creating this balance sheet from scratch, so kind of knowing what sort of descriptions exist out there. There's cash and equivalents is the most short-term, easily accessible stuff. It's bank accounts, maybe it's physical cash under a mattress, certificate of deposit, anything that's not really an investment product or in a retirement account that is specifically in cash, that's not moving and stable, typically falls in there. There's retirement accounts, which have some restrictions on how you access this money, but you get some tax benefits for making contributions, and there's some tax consequences of taking money out. Those are things like a 401k, an IRA, Roth IRA. So usually you want to make sure when you're creating this plan that these descriptions are important, so you know what the impact is going to be if you start reaching into these different piles of money or assets. Investment accounts would be less restrictive than retirement accounts, but less tax benefits, but those are sort of an in-between between your cash and your retirement. Is maybe you just have some money in a taxable or joint brokerage account, some mutual funds. Obviously, right now, in a period where the market is down, it's less than ideal to have to pull into investments. But again, it's there's sort of a try to understand what you can best do before having to do that. And then if it ends up having to be a decision you make where you pull money from investments, that's a great opportunity to talk to an advisor like us to kind of help determine what that impact will be and then how you might be able to make that back up when things are better. And then personal assets are the things that are usually you don't want to have to get rid of in these times, but real estate, vehicles, personal property. Personal property is one where if you're trying to just sell to make some money and shore up some cash, that might not be a bad place to look as well. And then liabilities, things we owe: mortgage, vehicle loan, student loans, credit cards, lines of credit. We'll kind of expand on that here in a sec. For assets, we want to make sure we put a description. What is it? Category, sort of what I was describing. Is it cash? Is it retirement, investment, personal property, personal assets? The current estimated value. For cash, that's relatively easy to do. For investments, surely you've seen your investment accounts moving up and down in value. That's perfectly normal, especially when markets are turbulent. There's a lot of uncertainty, and that's essentially what's causing that in these public markets. But hopefully you have a tool that sort of lets you know on a real-time basis, whether it's a Mint or whether it's an e-money, one of those tools that I mentioned before, what the value is as it changes from day to day. I would say don't worry and fixate so much on how that feels, but more so just be aware of why it's moving the way it is and what that should look like when things even out. And then ownership, how are these assets titled? Just to make sure you know if it's individually owned, if it's owned by a trust, if it's owned by you and another tenant, as they say, or another individual. So you know it's accessible. Liabilities, we'll describe them, same thing. What kind of debt is this? What category is it in? Is it a fixed, is it installment, or is it a revolving category? Is it fixed or variable interest rates? The balance on these debts is obviously important. And then in the maintaining cash flow part of sort of emergency planning, you really want to focus on the minimum payments that are due so that you don't unnecessarily put yourself into default. And again, we'll kind of talk about right now in this crisis what some tools are that are available to help you avoid defaulting on any sort of loans. So here's a quick snapshot of a balance sheet, just sort of applying what it is we just talked about. You may have seen a version like this before. Again, this is just a quick and dirty spreadsheet, something that we'll make sure everybody gets access to the slides. So if you want to just kind of copy this over in your own Excel spreadsheet, you can. Doesn't need to be formatted. This is just to make it clear to read. But again, I've grouped on the left-hand side. Usually you want to put assets on the left. I've grouped the category column. So there's cash, there's investments, retirement, and personal. And then there's a description for each of these things. So a couple bank accounts, a health savings account that's there for medical expenses, some investment accounts, the IRAs, and then some personal assets. And then the purpose of these things that you don't really need to focus on right now, but in the broader picture, I like to sort of define what they're being used for. And then the value of them, that should be whatever that is for you. And then the ownership is your name. And then on the liability side, again, category, the general two are installment, things that are sort of regular monthly payments, versus revolving, where you have a credit limit or line of credit you can go up to, but you can pay that down. And the minimum payments are usually less than in the installment scenario. And some examples there, again, are mortgage, vehicle loan, student loan, personal loan, the balances for those things. The interest rate is something to pay attention to. Is it fixed? Is it variable? Will it move up and down? And then what is it? And then the terms of the loan, how long, how many more payments do you have left on this thing? And then what is that minimum payment that you're making? On the revolving credit side, you want to make sure with credit cards or lines of credit that you're very aware of what the limits are so that you don't maximize that. You want to make sure, ideally, you're not having to carry balances on credit cards, but in these kinds of circumstances, obviously, there's some of us have less decision making, or less opportunity to not do that. So it's just about knowing what your limits are, and then hopefully what the interest rates or the APR is on these cards, so that if you're having to carry a balance, you can prioritize the card that has the lowest interest rate that you're paying currently. And then a cash flow statement. So this is pretty easy. It's just planning for inflows and outflows. The place that I would recommend starting right now, especially if there's income disruption, is the expenses, and organize them by priority and category. This will help you understand which expenses are the most important to maintain your household, and then which ones we can start making adjustments to when you have to go lean during these time periods. It can be really helpful to categorize those by category, whether they're fixed or variable expenses, the frequency at which they occur, and that's pretty much it. I think of expenses as, when you prioritize them, they're sort of like a pillar, where your most important household expenses, sort of your overhead, is at the bottom of that pillar. Your more discretionary or adjustable fixed expenses, things like travel maybe, are at the top of the pillar. And you want to focus on the bottom of the pillar. You don't want to have expenses that are needed to keep just your basic lifestyle afloat be neglected, and then not be able to actually make some adjustments to the stuff that's more discretionary. So focus on what the priority is, and it's a good time to kind of, you'll learn about what things are most important during these times. Examples of the inflows would be earned income, if you still have it. If not, maybe a lot of folks are getting laid off in Austin Tech, for example, so some severance packages are being given. We'll talk a little bit about unemployment benefits and how those have been impacted, but for folks that have been either furloughed or laid off, generally not fired for cause, there's opportunity to apply for unemployment benefits. Economic impacts tax payments, Daphne will spend some time on that, but as part of as part of the CARES Act stimulus package, there's some refundable tax credits that are going to be going out. Outflows, there's housing, transportation, healthcare, daily living, debt payments, dependent care. Here are some examples in these different categories. So housing, mortgage, rent, property taxes, homeowners, renters insurance, utilities. Transportation, be like a vehicle loan, vehicle insurance, gas and fuel, oil changes. Registration inspection, probably the last thing you're worried about. This one, that's kind of an annual, get to it when you need to, but a required expense. Healthcare, making sure your health insurance premiums are paid. COBRA is something that's been around obviously long before this, that allows folks that have been laid off or let go from work to continue maintaining their employer plan for generally up to 18 months. The big thing with COBRA is that if your company was paying for some of your health insurance premiums, that usually goes away unless they elect to do that. And you will then be responsible for paying 100% of the premiums to maintain that coverage. But health insurance premiums, obviously amidst a global pandemic, are pretty important, because we know that if you end up having to go see a medical professional, you want to make sure that you have a stopgap on your costs. Prescriptions, same thing. You want to make sure that any existing conditions that you're maintaining are prioritized. Copays and coinsurance are, when you start going interact with the medical professionals, you pay that. Quick and dirty example of the cash flow statement is organizing the inflows, and that's what we've got at the top there. And then again, I've got a type, so it's monthly recurring, a category, what is this coming from, and then a description of this thing. And then sometimes it's really hard for people that, specifically when it's earned income, some folks get paid weekly, some get paid monthly, some get paid 24 times a year or semi-monthly, and then others get paid every other week, which ends up being 26 pay periods. So it's not really 2 times a month. It's 2 times a month for all but 2 months where you get 3 paychecks. So what I like to do is use a per period dollar amount. So if it's monthly, the per period will be the same as monthly. If it's semi-monthly, the per period will be what you get paid 24 times a year or 2 times a month, and you can just multiply that by 2 to get your monthly amount. If it is every other week or bi-weekly, then you would take that per period, whatever you get paid each bi-weekly pay period, multiply it by 26 to get the annual amount, and then divide it by 12 to get your true monthly amount throughout the year. During these times, folks, again, you may not want to be think out to 8-10 months in the future. So it may be simple just to say, well, this bi-weekly pay, I'm actually getting twice a month. Whatever works best for you. And again, if you have a chance to talk with one of us, we'll help you kind of understand the arithmetic behind it. Outflows, again, categorizing these things by the type. How often are they happening? Are they periodic? The category, and then a description for them. And then the same thing applies where I like to use a per period number. So if it's anything like, for example, I put home maintenance is something that happens maybe 4 times a year for somebody. You could say, well, how much do I spend each time that it happens? it's $100, you put $100 in that, and then multiply that by 4 if it happens 4 times a year, and then divide that by 12 to get your monthly amount. Those methods work a lot more importantly during stable time periods, but again, if you're wanting to kind of be able to flip this cash flow statement into a budget once you feel comfortable, or if your income hasn't been affected, this may be a good tool for you. And then once you've got the sum of everything together, you'll have total outflows, and then your net cash flow should be very simply the difference between your inflows minus your outflows is either a positive number if you're saving or a negative number if you're net spending. And then we, with clients, will use somewhere between 3 to 6 months of their total outflows is what we recommend to have in emergency funds. And we'll see with coronavirus how long this impacts people, but we'll see if that 3 to 6 months time period sort of applies. You know, ideally, hopefully we don't go 6 months for something like this, but we do know that you know, a lot of data suggests that we won't return to life, you know, within a month or two as it was before. It'll probably be a sort of a gradual approach to what we were at before. So there may still be some reduction in income or reduction in expenses until everybody feels more comfortable. Some quick tools and resources. On the inflow side, unemployment insurance has been expanded to include independent contractors and self-employed people. That's something that hasn't happened in the past. We'll give you some, on the resource page, some better information about specifically, you know, linkage to where to go to apply for it if you've been affected, and then some details on the federal government's supplement of what is normally state administered unemployment insurance. Unemployment insurance is still being administered by the states, but has federal backing to where now they've eliminated some waiting periods. They've increased the benefits people are getting monthly, and then they've increased the amount of time people can receive benefits, as well as the types of people that are eligible. So again, independent contractors and self-employed people. Economic impact payments, again, is the tax, refundable tax credit advances that Daphne will talk a little more about. And then something I didn't put in here, but we'll have a resource page as well that's more for small business owners, are the Paycheck protection loans and economic injury disaster loans. Are these 2 different programs within SBA that are part of that CARES Act legislation. And these are what, if you've heard about it in the news, these forgivable loans that are designed to try to help businesses either retain employees, really just to retain employees during this crisis. There's a lot of information that's fast moving on those, and there's been some good clarification brought out from SBA and Treasury Department. A lot of efforts by sort of professional associations like the Certified Public Accountant organizations have kind of asked for that clarity. So that stuff is getting published daily. We are going to make sure that there's some good resources, some resource links on the page that we give everybody that we'll be updating as well. We'll make sure that these sources are going to be the ones that are going in and making adjustments as more information comes out. There's a big rush to everything right now because a lot of people are impacted. So I think just as a result of that, it's unprecedented. So a lot of the information that's coming out is coming out as fast as it can. And then outflows. The government has generally advised lenders to work with borrowers on payment plans, loan modifications, and forbearances. I had a bit specifically on here about student loan payments that are federal. There is no required payment from now until September 30th, and there will be no interest accruing on federal student loans. That's something where I'll always say, I've logged into so many financial websites in the last several weeks and have seen almost a coronavirus, header page on almost every one of them saying, hey, if you're having problems, reach out and talk to us. People worry about lenders foreclosing or wanting to come in and, be aggressive when it comes time to them not getting paid for these things. And in normal conditions that's a reasonable concern, but right now the government is really emphasizing incentivizing and then also sort of requiring lenders to be a lot more flexible in these time periods, knowing that this is not going to last forever, but to work on some of these modification programs for the short term. Just a quick little graphic here. So again, this will be somewhere else where you'll be able to read it, but the CARES Act, that was this big $2 trillion stimulus package, has some different components that affect individuals, that affect distributions from some plans, that affect some charitable contributions, how unemployment benefits are administered. And then the big one on the right is the small business benefits, is that big loan package with a bunch of different kind of sub-programs. So this is just a quick summary of it. And again, you'll be able to see this in the slides, but we'll give you access to be able to read at length as much as you'd like about these things.
All right. Thanks, Ian. I appreciate that. Let me Give Daphne some control here.
So thank you, Ian, and thank you, Nicole. Let me go back just a little bit. So we're going to segue into talking about financial health for your family. And just to piggyback off of what Ian was talking about, you know, taking time to go through those exercises of figuring out and prioritizing your expenses is really powerful, because this is an action that's within your control. If you figure out that, then you can look at the total amount that you have in your bank accounts, divide that by living expenses, and then you know how much cushion, how much you have that's going to last you and everything. We're now going to turn our attention to the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act. This, as Ian mentioned, is a $2.2 trillion stimulus bill that was signed into law on March 27th. The main provision that people are really interested in are these recovery rebates, also known as stimulus checks. Some general rules for these is that they will base, if you receive this check, on your 2018 or your 2019 tax return. It's whichever one, the latest that they have on file. If you are receiving Social Security benefits and you don't need to file taxes, there's no action to take. The money will go into the bank account that the Social Security Administration has on file. Funds are going to be sent to you in the method that you receive your IRS refund, or a check will be mailed using the address of your most recent return. Now, recently, TurboTax has partnered with the IRS to create a stimulus registration page. This is a site that low-income Americans, meaning some with income that's below the 2019 standard deduction levels, they can go to this site, they can enter their direct deposit information there and their mailing address. It's free to use. The IRS has already mentioned that they are going to develop a web-based portal. The TurboTax solution is not the same as what the IRS is talking about. We will include this website on our resource site. When it comes to the amount that you will receive, it's going to be based on your adjusted gross income. That's line 7 on your 2018 taxes, or line 8B on your 2019 taxes. So they'll look at your filing status. And for example, if you're single or you're married, filing separately, if your adjusted gross income is $75,000 or less, you can expect a stimulus check of $1,200. Married filing jointly, you can see the AGI amount. It would be a stimulus check that would be double that amount. If you have children that are living with you that are also listed on your taxes, you would receive $500 for each of those kids. There is a calculator that you can go to see exactly how much you would receive. If you're over the threshold, then there's going to be a decrease in the amount that you would get. It's a reduction of $50 for every $1,000 that's above the threshold. So there's a little chart here, but kind of in summary, like if you're a single filer, you would phase out if you're over $99,000. And if you're a joint filer, you would phase out at above $198,000. These taxes are not taxable. That is a question that keeps popping up. This is technically a 2020 refundable credit that you're getting now. There's a couple of special scenarios I would like for you to consider. For example, let's say you were married in 2018 and then in 2019 you got divorced. So in such a case, you might want to go on and file your taxes quickly so the IRS has your most recent and individual information. If you experience income lower this year in 2020, then it's very likely impossible that you're not going to receive your funds until you file your taxes next year. But the flip side of that, if for some reason your income was lower in 2018 or 2019 and you get a stimulus check, and then this year your income is higher, you're not going to get penalized next year when you file your taxes. The million-dollar question is, when can we expect our stimulus check? Well, the latest information is saying that direct deposit checks are going to be paid during the week of April 13th. If you are waiting for a check, it's going to take a little bit longer. So I just suggest staying tuned for date changes, because this is the first time they're doing this type of method. So there could be some more changes. Another provision is the coronavirus related distributions. So basically, this is allowing you to take up to $100,000 distribution from IRAs or employer-sponsored retirement plans. We kind of consider this a last case option. It's generally not a great idea to break into your retirement bank early, but if you have to, you're able to do so. And if you do, there would not be a 10% penalty. But you would pay federal income tax on the distribution. Now, in order to qualify for this, you have to be impacted by the coronavirus under very specific eligibility rules. And we'll make sure that we make those rules available to you on our resource site. The silver lining here is that you can repay the funds that you take out over a 3-year period. And if you do so, it would be a good idea to file an amended tax return so you can claim a refund on tax that was paid. Here are a few other things to consider. Ian already hit on this, that if you had a job loss, that would be a qualifying event, and then you could tap into COBRA, which is you taking over your health insurance that your employer had for you, and that's generally an 18-month coverage. As I said, you would take care of the premium yourself. Sometimes there's a 2% administration fee with that. You could also go to the marketplace or healthcare.gov to see what you would qualify for there. Tax filing has been pushed back from April 15th to July 15th. If you are over 72 or older, or if you turned 70 and a half last year and you didn't take your required minimum distribution last year, you were going to take it this year, well, in 2020, those are waived. So that would be taxable income that you wouldn't have to consider if you did not want to take your required minimum distribution. If you did have a loss of employment, you can also consider rolling over your 401k. And that's something that an advisor like us could help you look at those possibilities. Speaking of retirement accounts, we are all acutely aware of the recent market happenings. So volatility can be expected, and this is an element that's outside of your control. So once again, as we've said earlier, it's important to focus on what's within your control. And when it comes to your investments, here are things that are within control. The purpose of investing in the market is for the future. It's for later when you want to be financially independent. It's for later down the road when you are retired. So it's important to be diversified. Now there's a little chart that's on the right-hand side, and I know you can't see the wording, but each of the squares represent an asset class, like large companies, small US companies, real estate, international companies, etc. And it ranks all of these different asset classes from highest performing to lowest performing each year from 2000 to 2019. So if you just kind of zoom in on that dark blue tile, you'll see that in that first column, it's near the bottom. But then if you look at the last column, it's at the top because it was the highest winning asset class that year. And this is specifically US large companies. There's no rhyme or reason to which asset class is the winner, so to speak, each year. There's no pattern. So that's why it's important to have a slice of it all to be diversified. It's important to be properly allocated, meaning you have the right recipe of equities and fixed income. It's important to be low cost, meaning that owning mutual funds that are at a low cost to run and don't have commissions on them. Remember, all of this starts with being in a strong mindset. Doing so is the start of setting yourself up to think clearly and to make strong and favorable financial decisions.
All right, so it looks like we are gonna take some questions at this time. And it looks like we do have a question regarding stimulus checks. If you have had a child recently that was not listed as a dependent on last year's taxes, will you still be able to receive the $500 per child? Or will that be received on next tax return?
So it's my understanding that if you had the child this year, in 2020, you will receive that rebate next year.
Great.
Yeah, it's a great question.
For that $500. And there's no limit they didn't put a limit on the number of children, so that's $500 per each qualifying child.
Perfect. Thanks.
Yeah, and I'll just expand on that real quick because, like Daphne had explained, this rebate is essentially in advance, and they're making an estimate using the most recent data that they have, which is, funny enough, could be 2018 for a lot of people, and it could be 2019 for people who have filed their taxes already. But obviously they extended that deadline, so some people haven't done that yet. So because it's an estimate, they're doing what they can based on previous years, but like Daphne said, that should get trued up on your tax return for 2020, which we'll file at the beginning of next year.
Great. I have another question that came in before. So if you have a student in college, do you still receive $500 for that child?
Sure, that's a great question. The answer is no. It has to be a qualifying dependent, so that would be kids that are under age 17. So somebody that's showing up, a child that's showing up on your taxes, so that means that you're providing for more than half of their expenses for more than 6 months during the year. So that's something to keep in mind for divorced parents for how all of that works. So a side note is that elderly dependents, so if you have an elderly parent that's listed on your taxes, they're not going to, of course, qualify for the $500 rebate.
Cool. Great, thanks. And I think I have one other open question. So if I've prioritized my expenses, what is the best thing for me to do with my stimulus check?
So I'll take this one. I would say in in this particular time period, sort of like what I was talking about earlier, where the biggest part of your financial picture is cash flow, just maintaining the monthly overhead that you have, and not forcing yourself to eat into too much cash to where all of a sudden now you have to look to acquiring more loans or pulling money from retirement accounts or pulling money from investments. I would say for anybody that doesn't already have 3 to 6 months of their expenses in savings, add that stimulus check to your savings account and don't look to cast this thing out into the future. There's so much uncertainty, and even folks that still have their jobs currently, there may be a change in the next 2 weeks, or there's just a lot to be seen in a lot of parts of the economy. So I would say holding onto it in cash, or if you are struggling and worried about a debt that you're not able to get sort of a modification or a forbearance on, then maybe keeping that cash on hand to keep making those debt payments. I wouldn't even say pay the debt faster, but rather use it to make those minimum payments for as long as you can, so that you don't worry about formally defaulting. But again, in this particular time period, a lot of lenders are just, they're kind of being forced to, and guided by the government rather to work with borrowers, because it does not benefit them for borrowers to completely default. They don't want to have to call in these loans. They want to keep having you make payments, so they'll usually work with you to be able to do that.
Great, thanks, Ian. All right, I have a follow-up question about the child in college. Would the kid in college get their own credit check if they aren't getting money from their parents?
That's a good question. So I would say that if that child is filing their own tax return, that's possible. So I would say, yeah, so I would say that that's very possible. I would have to think about that a little bit more.
Thanks, Daphne.
Okay.
All right, new question. Recognizing you don't have a crystal ball, but based on your experience and understanding of history, when do you think the market, i.e. my investments, will come back?
No crystal ball. That's no fun. Yeah, no, that's a great question. What we can base our understandings of short-term. I mean, short-term investment predictions are just always so tough. We all had a collective feeling even years ago that we had hit a peak, hit a high in terms of the markets. And obviously we were at the tail end of the longest bull run we'd had where the trend was upwards up until things started to fall off in January. So it's really tough to make those predictions in the short run. But I think what we'll do is make sure that we have some good slides on the resource page that show you some just long-term data going back to the 1920s that show you the average period of a downturn, and then typically how long it takes for things to recover, both to where they were at before and then to march forward ahead into positive territory again. But I can tell you without a doubt, bear markets last significantly shorter historically than bull markets do. So, I'd say an average, if a bear market average is somewhere between 12 to 18 months or so, a similar recovery time period. In the next 1 to 2 years from things being at the very bottom, things should have moved their way back close to the top. Again, all we can do is go off of averages. Every situation has some uniqueness to it. So I won't ever hang my hat on something like that. But there is some good slideshow stuff that we always present to clients. And when you see these averages, you start to realize that they're a lot more consistent than we think that they are. And that's what, for our clients, our investment portfolio methodology is, heavy diversification, low cost, and then basing our decision-making on including, at tens of bear markets. We've had at least 13 bear markets since that 1920s time period. So those are all priced into the way that we recommend our clients invest money. So these time periods that are down, even if it's coronavirus related, don't really scare us as being unique. It's more so making sure that we stick to the plan and don't have to go in and start, again, selling the stuff before it has time to recover. But I would say, again, 1 to 2 years from the down period is reasonable for an average recovery.
Yeah, as Ian just very eloquently elaborated, we know the past, we can't know the future, of course. So that's why it's really important to make sure you're allocated correctly. For example, if you're younger, it may make sense for you to be 90% in equities or 80% in equities and the reverse in fixed income. If you're older, you would want to have more fixed income. Because the point is, you ask about, when will things come back for me? When will my investments come back? If you're allocated correctly, you have time to recover. So.
Yeah. And I'll make an additional point to what I said about something that's kind of, I always found fascinating about public security markets are basically things like the S&P, the NASDAQ, the Dow, where we see the prices of these companies being traded on a daily basis, minute to minute, every day, generally for the majority of our lives, is that it's easy to feel the worry when things are on the downswing, but oftentimes in the upswing, I feel a lot of that same worry just because it's a lot of different investors trying to use as much information as they have available to make an estimate of what the price of these things should be. And oftentimes that is based on the expectation of future profits for companies or future cash flows for bonds. And so when things kind of come to a standstill, it kicks the leg out from underneath what they're making their estimates on, that the fundamentals are sort of now a little more up in the air because there's only so much you can predict. And for that reason, a lot of people sort of panic or start to price in that uncertainty in some way. But what we know for sure is there's a lot of companies that have lost a lot of value in the market, in their stock prices, that are still very fundamentally sound. And that's a big part of our investment philosophy too, is we have a broad diversification, but a lot of heavy allocation to fundamentally financially strong companies with a long track record, so that they're the ones that are able to survive these downturns. While we will probably see, some segment of the startup economy, as it happens in these boom bust cycles, go under. But the good news for our clients is we've always emphasized diversification and reducing that risk where possible.
Thank you both. It sounds like you're saying that we have to focus on what we can control, like diversification, portfolio allocation, and then not making selling decisions if we don't have to.
Indeed.
Yeah.
It seems simple, but it's tried and true. It's the good stuff.
Right.
It's objective. It's data. It's what we can count on.
So I just wanted to say that we understand that people may have questions that are specific to their own situation. There is going to be a survey after this webinar that's going to ask for some feedback about this presentation, and is also going to ask you if you would like a complimentary consultation with one of our advisors. So if you could just take a couple of minutes to fill out that survey at the end of today's call, that would be really appreciated.
Thanks, Nicole, for setting us up here, and Daphne for
Yes.
everything that you've contributed here. This was great. We really appreciate everybody being here and taking the time for this.
Yep, thank you so much.
We thoroughly enjoyed talking to everybody.
Great. Thank you, Daphne. Thank you, Ian. One other disclosure, this presentation is for educational purposes and informational purposes only. Past performance does not guarantee future results. And if you have any specific questions, feel free to reach out to one of us to answer that offline. Thank you guys so much for joining us today, and we will be ending today's webinar.